Thought leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. Thanks for joining us today as we jump into current topics in accounting and reporting. For today's discussion, I'm pleased to welcome guest host Diana Stoltzfus, a partner in PwC's National Office and a podcast regular. I'll hand it over to Diana for more details on today's episode.
Today, we're talking about hedge accounting, what's changed, what's ahead, and what it all means for companies managing interest rate, foreign currency, and commodity risk. The FASB recently issued new guidance that makes targeted but meaningful changes in several complex areas of derivatives and hedging. And we'll talk through some of these updates today. In addition, the board has outlined additional hedge accounting projects that could further reshape parts of the model. So lots happening in this space. To help break it all down, I'm joined by Nick Malone, a partner in PwC's financial markets and real estate practice, and Chip Curry, a partner in our national office. Both bring deep technical knowledge and experience working with clients and engagement teams on these issues. Thanks so much for joining me. I'm looking forward to the discussion. So I thought we'd start off today by talking about what you guys are seeing in the hedging space, what's coming up in client conversations, and what you're seeing from a hedging activity. So Nick, maybe I'll start with you.
Yeah, thanks, Diana. So we're definitely having a lot of conversations with clients about derivatives and hedging and sort of risk management in general. It's a topic that always seems to be top of mind for a lot of our clients. And certainly today, given the volatility in interest rates, foreign exchange, and commodity markets, their clients are actively managing some of these risk exposures, and they're evaluating different hedging strategies. Tenors, risk profiles, risk tolerances, are their programs fit for purpose given the volatility we're seeing in today's markets? Not all hedging strategies involve the use of derivatives, though. There are a number of tools at the disposal of our clients to manage risks. You can manage risk by changing your interest rate risk profile of how you fund yourself. So fixed versus floating, the tenor in which you're issuing debt. But derivatives are often used in these risk management strategies because they're really sort of effective and efficient ways to manage the risks, and they can be cost effective.
Yeah, I agree with everything Nick just said. We're seeing the same thing from questions coming up through our national office. And you referenced this a little bit when you kicked off, that we are definitely seeing some standard setting activity, right? So they issued new guidance in November, which we'll talk a little bit about, and they've sort of laid out a path forward for future amendments to the standard. They've kind of broken it up into like short-term projects, a medium-term project, and a longer-term project.
Okay, well, Chip, you mentioned that there was some new guidance that came out in November. So let's start with that. Can you give us an overview?
Yeah, sure. So for everybody who likes to write this stuff down and keep track at home, it was ASU 2025-09. And we published an in-depth summarizing that guidance, but it really impacts 5 areas. So the first area is it changed and provided new guidance on how you do a similar risk assessment for cash flow hedges. So think about this when you're trying to hedge multiple transactions together in a single hedging relationship, and how you demonstrate that those risks are similar so that you can and you are allowed to hedge them together in a single transaction. The second thing it does is it effectively provides a new model for hedging choose-your-rate debt. So choose-your-rate debt are variable rate debt instruments where the issuer can elect to change the interest rate index or the tenor from a list of specified rates within the debt agreement. It provides new guidance and a new model for hedging cash flow hedges of forecasted purchases and sales of non-financial assets. It eliminates the current model or the previous model that existed where you could hedge contractually specified components with a new model that allows you to hedge components and subcomponents of transactions. And this new model works for purchases that are either executed under contractual agreements like forwards to acquire non-financial assets, but it also works for transactions executed in the spot market. The last 2 things are a little bit more specific. It provides a new scope exception from having to do the written option test for certain interest rate hedges when you're using interest rate swaps. Would that have embedded written options? And it changes the guidance for what people call dual hedges. It's not a super common transaction, but it involves where you have foreign denominated debt, so a debt liability that has been designated as the hedging instrument of a net investment hedge, but it is also the hedged item where people are hedging fair value risk. So a little more complicated, a little less frequent, but those are sort of the 5 areas.
Wow, those are some pretty specific areas that were addressed by this new guidance. So maybe just thinking about what of these amendments will impact the broadest amount of companies. Nick, what's your thoughts on that?
Yeah, thanks, Lana. You're right. I think they are very specific, sort of very targeted changes, but they are all in response to feedback that the FASB's received. I think the guidance on the Chip mentioned on the similar risk assessment and the net written option relief are probably, likely to have the greatest impact on some of our financial service companies. And for the non-financial service companies, I think the guidance on choose your rate debt is likely to have a big impact as well. As Chip mentioned, for choose your rate debt, it allows the borrower at each sort of interest reset date to choose from a specified list of rates that they're going to pay interest based off of. We see this a lot in borrowing facilities where the borrower will have the right to borrow either overnight SOFR, 1, 3, 6 month term SOFR, and they have that choice every interest period, which rate to choose. And so under today's guidance, if you wanted to get hedge accounting and get sort of favorable hedge accounting treatment, you need to be sort of very specific in terms of asserting what rate you're hedging. So even despite the flexibility that the contract gives you, you're really picking up, I assert that I'm going to only pick overnight SOFR despite the fact that the contract gives me other options. And that's the way to sort of get favorable hedge accounting today. And so that obviously removes a lot of the flexibility that's inherent in the contract.
Yeah, so it seems like it basically takes away the benefits of entering into that contract if you essentially have to make all those choices up front.
Yeah, exactly right. And I think so what the new guidance is designed to do is it's supposed to allow companies some flexibility in terms of choosing those, picking those different rates at different times during the life of the borrowing without having to worry about missed forecast transactions and without having to and redesignate the hedge, provided that the hedge remains highly effective. And so you kind of think about this model as having a number of exceptions to the normal cash flow hedging rules. So it's not something that can be analogized to. It only applies to choose your rate debt. Probably not a surprise to people, but there are a list of rules that you need to comply with to follow this model. And even deeper than that, the rules are a little bit different for existing choose your rate debt. So the debt that's outstanding currently as versus choose your rate debt that you might issue, in the future, like forecasted debt issuance. So again, the rules are probably a little bit too complex or nuanced to get through in a podcast like this. So maybe just to hit on a couple of the key aspects of the model as it relates to existing choose your rate debt. That's probably sort of the most, I think, impactful immediately for companies out there. So again, one of the things I already mentioned about the new model is it allows the issuer to exercise sort of the optionality in the debt without, worrying about missed forecast transactions and redesignation. The way to do this is in terms of the company's hedge documentation. What they would write down in their documentation is sort of list out all the different indices that the contract would allow them to borrow off of. So again, like overnight SOFR, 1, 3, 6 month term SOFR. And because all of those choices or tenors are written down in your hedge documentation, if the company does elect to change the rate from, say, overnight to 1 month term SOFR, it's not considered a missed forecasted transaction because it was outlined and written upfront in the hedge documentation. So in terms of assessing effectiveness under this choose your rate debt model, similar to existing hedge accounting, it's at least quarterly, but there's also an incremental requirement that to assess effectiveness if and when you actually choose to change the index you're borrowing off of. So, you're sort of you get to sort of ignore the optionality while you've chosen a rate. So if you choose overnight SOFR, you're assessing effectiveness based off of overnight SOFR until you choose a different rate. And so when you choose that different rate, you would sort of update your hedge document, your hedge effectiveness assessment to be based off of now your 1 month term SOFR option. Right. And just making sure that assessment of effectiveness shows that the hedge is still highly effective given the new rate you've chosen.
Okay, so I get it. So basically, you're looking at the contract and you'll look at the effectiveness, like the rate that you had chosen previously. You do that when you're doing your retrospective test. And then you think about, as long as you're choosing one of those options that was written down in your initial, hedge documentation, then you would use that for your effectiveness test going forward.
Correct. Yeah. And sort of very similar to today, if you fail your retrospective test, the backward looking test, you don't get hedge accounting for the past period. If you fail your prospective test based off of the new index, you don't get hedge accounting in the subsequent period. So that's very similar to hedge accounting today. I mentioned the model's pretty complex, so there's a lot more to it than what we talked about, and there are some maybe what you call downsides to it. For example, because of the way the model works, it's less likely that you're going to have a missed forecast, but the consequences of having a missed forecast are probably a little even more severe than they are under current GAAP. There's also some sort of nuances around, incorporating the ability, if you wanted to replace existing choose your rate debt with new debt in the future via some sort of refinancing. There's some very nuanced rules around that. And so because of all that, this new choose your rate debt model is elective. It's optional. You don't have to use it. You could still apply the sort of the current GAAP around, I promise or assert I'm only going to borrow based off of this rate despite the flexibility. So even you could still use the current guidance even with all its limitations. If you don't want to, if for whatever reason you don't want to comply with the laundry list of rules in the new choose your rate debt model.
So it sounds like entities that are thinking about using this model should evaluate, or that are entering these types of transactions and want to get hedge accounting, you can evaluate what might make the most sense. But it seems like there are a lot of rules and details that it's important to understand and how that interacts with your own facts and circumstances. So maybe, Chip, you mentioned that another one of the changes related to hedging purchases and sales of non-financial assets. So maybe we can pivot to that.
Yeah, so maybe we start out prior to the adoption of the ASU. What does the landscape look like if you're looking to hedge like a forecasted purchase or sale of a non-financial asset? So what are we talking about here? We're talking about situations where you're a company that needs to acquire like a raw material to use that in your production, and what you're trying to do is hedge the variability in price of what that raw material is going to cost you in the future.
Mm-hmm.
So what could you do before the adoption of the ASU? Well, you could really do three things. One is you could hedge FX risk. So if you're a US dollar functional currency company and you're selling non-financial assets and those sales are going to be in euro, then you can hedge the FX risk. And nothing's really changed on this ASU with your ability to do that. The second thing you could do is you could hedge the overall variability in purchase or sale price. And again, nothing's really changing from the ASU. The third thing you can do under current GAAP is if you have a contract to purchase or sell a non-financial asset, and that contract wasn't being accounted for as a derivative in of itself, like for example, if you were elected the normal purchase, normal sale scope exception. If that contract has like a variable price component to it, you could hedge the variability of that contractually specified component. So sometimes when people enter into forecasted purchases of raw materials, what the contract would say is you're going to pay like a rate, the formula for the price you pay is going to equal to like a spot price or a price of at a liquid location plus a fixed delivery cost. So if you had a contract that said that, you could hedge that specific contractually specified variable component. That model, that third model we talked about, the contractually specified component had a number of issues with it. The biggest issue that people identified is it didn't really work when you were buying something in the spot market. Because when you buy things in the spot market, there isn't a contract that spells out the terms for the price of purchase. You just get a receipt saying how much you purchased and at what price. So for example, when you pull your car into the gas station and you fill it with gas, you don't sign a contract that says I'm paying oil plus this minus what. You just get a receipt that says you paid, what's it now? Over like $3 a gallon, right? But whatnot. So what's changing? So what the new guidance does is focuses on hedging components and subcomponents more broadly. So to identify like what's an eligible component or subcomponent, the new guidance leverages the clearly and closely related model from the normal purchase, normal sale guidance. All right, so what does that mean? So if you have a contract to purchase or sell a non-financial asset, and that contract has a variable price component, you can hedge that variable price component as long as you can demonstrate that that variable component is clearly and closely related under the normal purchase, normal sale model to the non-financial asset. So that's step one of the model.
Okay.
Now that doesn't sound like a radical change. It sounds
kind of like the model we have today.
Exactly. With the addition of the clearly and closely related.
Yep.
Okay. But so now what the new guidance would allow you to do is hedge a subcomponent of that contractually specified variable component. So I'll steal an example from the standard. So let's say you have a contract to purchase copper wire that you're going to need, and that contract is not being accounted for as a derivative. And when you look at the terms of that contract, the price that you're going to pay per pound of copper wire fluctuates based upon like a copper wire index. Call it the ABC copper wire index, plus some sort of like fixed spread. Well, you might find there's no liquid derivative on the ABC copper wire index, but you can demonstrate that the ABC copper wire index price is based upon like a price of raw copper plus processing costs. So if you can demonstrate that copper costs are clearly and closely related to that copper wire index in the contract, then, and you can prove that the index in the contract is clearly and closely related to the final product, so it's like a two-step test, then you can hedge a subcomponent. So that's a bit complex. There's a couple of things you need to demonstrate, but the concept is you can hedge a subcomponent of a contractually specified component if you can prove that the subcomponents clearly and closely related to the component, and the components clearly and closely related to the overall asset you're purchasing. So that's new. That's different. It allows you to drill down at a more granular level. So that's sort of the change when you focus on like contractually specified components and contracts to purchase or sell things where, that have a variable component. That's the big change.
Okay, so I see your point related to now the ability to hedge these subcomponents. But you also mentioned there was some criticism in the current model that was focused on spot market. So maybe back to your example related to the gas prices.
Yeah. So now the model will also work in the spot markets because we're not necessarily focused on whether you have a contractually specified component. We're trying to identify whether there's a component that's clearly and closely related to the overall purchase or sale price. So when you're purchasing in the spot market, like we talked about, like in the gas example, there's no contract to look at and see variable components. The purchaser and seller negotiate a price that you're going to pay, or perhaps the seller, like in the gas station, posts a price and you agree to pay it by pulling in and filling up your car. So what you can do in this case is you can hedge a component of spot price. Subcomponents not really a relevant concept in spot markets. That's when you're hedging a portion of a contractually specified component, but it's the same concept. You can hedge a component of overall spot price. So again, like stealing from the example in the standard, let's say that you're a company and you're going to be purchasing soybeans and you're going to be doing that in the spot market. And based upon where you're buying the soybeans, the location and the delivery location of those soybeans, you know that the soybean index price, like an index price, like the example they use is another ABC index price, that's how the market prices. What you could say is well, that's an eligible component because I can demonstrate it. That index price is clearly and closely related to the purchase price of the asset at that location. And instead of hedging the overall purchase price, I can just hedge that component.
Okay.
So same concept, right? Hedging components and subcomponents, same rules. You have to prove each step along the way that it's clearly and closely related, but it allows you to hedge things at a more granular level where you're not always forced into hedging overall purchase price or sale price.
Okay, that's helpful.
Yeah, I think some of the changes that Chip just talked about, like the ability to hedge a component or subcomponent of a purchase or sale of a non-financial asset, or hedging components in the spot markets, could really open up a lot of opportunity for companies to apply hedge accounting. I think today in this space, in the non-financial hedging space, we often see derivatives utilized as economic hedges of exposures. But sometimes, hedge account, because of the current rules or the current guidance, the hedge accounting isn't applied. Or maybe we see companies applying hedge accounting, but the company's seeing noise in the hedge effectiveness results as a result of some of the current rules. And so I do think the ability to hedge, components or subcomponents, as opposed to overall purchase price are in many cases going to make hedge relationship more effective. And so I think, like Chip said, I think the magic in this new model is sort of defining and identifying the component or subcomponent that you're going to hedge. And then typically, I think the expected result is that you're going to have a much more effective hedge result.
Yeah. Now, I mentioned a couple of times this clearly and closely related requirement, and that it's based upon the clearly and closely related guidance in the normal purchase, normal sale guidance. So just as a quick
refresher,
circle back,
maybe.
refresher on that. So normal purchase, normal sale is a scope exception in the standard for contracts that would otherwise be derivatives. That if it's probable you're going to take physical delivery and you're going to use that in your normal production and to run your business, then you can elect to apply a scope exception. To apply that scope exception, when you have variable price components in that contract, you have to demonstrate that they're clearly and closely related. And the clearly and closely related guidance, right, Nick, it's a little bit different in normal purchase, normal sale than like the normal clearly and closely related guidance that you would apply if you're assessing for embedded derivatives in like debt instruments or things like that.
Yeah, I think in general, I guess the way I sort of think about it is the scope exception in normal purchase, normal sales is a little bit more structured than the sort of the general clearly and closely related guidance around embedded derivatives. For embedded derivatives, you're typically looking at just like the overall economic risks and characteristics of the embedded derivative versus the host contract. Under the normal purchase, normal sale scope exception, clearly and closely related is getting more at or asking you to do more around the actual sort of pricing, the pricing impact of the component. So both, the literature talks about both qualitative and quantitative analysis of the pricing features within the contract. It says, the pricing feature can't be extraneous or have a sort of disproportionate impact on the price. It's effectively sort of looking at and saying, is the component or subcomponent, expected to, have an impact on the price in a manner that would be comparable to, if the parties were to sort of reprice the contract under then current market conditions, at each delivery date. And so it's similar concepts, but a little bit more structured, a little bit more focused on the pricing impact of the component in the normal purchase, normal sale scope exception, again, versus the sort of general clearly and closely related guidance for embedded derivatives.
Okay. Well, so we've covered two of the aspects of the new derivative guidance, the hedging, choose your rate debt, and hedging of purchases and sales of non-financial assets. But you mentioned at the beginning, Chip, that there's also more items on the FASB's agenda, both the short-term and long-term. So what do we see coming?
Yeah, I mean, it's a timely topic to be talking about here. So we went through two aspects, and one of your observations, rightfully so, is there's still a lot of rules. And one, I think, of the issues that they had in making these changes is without changing some of the fundamental framework of the derivative guidance, you're sort of, one, limited to what you can do if you want to operate within that framework. And two, when you want to do something outside of that framework, you have to make exceptions. So that's why, like Nick said, the new choose your rate debt model has to be thought about like as an exception to the normal rules.
Right.
Because to get it to work, to get that flexibility, they had to create exceptions. So at the end of February, the board met to sort of chart out this path forward. I think we mentioned that a bit before. And when doing that, they thought about some of the things that were brought up to them. And I think we've had discussions about this or webcasts about this too. Like FASB did their invitation to comment where they were seeking input. So they took a lot of the feedback on hedging that they got as part of that invitation to comment and come up with their kind of short-term, medium-term, and long-term goals.
And what does that look like?
Yeah, so I think it's just piggybacking off what Chip said. I think it's important just to remember what we talked about earlier. So the choose your rate debt and the hedging the components of forecasted purchases and sales of non-financial assets, those are in the standard, the ASU that was already issued, and those can be early adopted. So those are out and sort of final rules. The project Chip's talking about, the short, medium, and longer term projects, these are sort of different or incremental to the ASU that was already issued.
Yeah, absolutely. I mean, very fair point. Those things we talked about earlier, you can early adopt that new standard. This is all still, what we're going to talk about next is still coming. So,
okay.
So, I mean, I guess we'll start logically maybe and start with the short-term project. So the short-term project, as currently contemplated, has three elements of it. One is adding the ability to hedge interest rate risk of held-to-maturity securities. The second is removing the overnight index swap language from the guidance defining what is a benchmark interest rate. And the third is allowing float-to-float cross-currency swaps that have different reset dates qualify for hedges of net investments.
That sounds like some narrow improvements to the standard.
Yeah, I'd agree. I think they're narrow in scope, but I think they are potentially pretty impactful. I think the first thing Chip mentioned about the ability to hedge interest rate risk on held to maturity securities. It's probably a big deal for a lot of our bank clients. I think that's something they've wanted to do for a long time, and the rules will allow for that. I think the second point Chip brought up about sort of an expansion of the definition of a benchmark where interest rate from just overnight SOFR to now incorporating some of the term SOFR indices that are out there that are heavily used. I think that would be helpful in terms of making it easier to get hedge accounting when you're using swaps that are indexed to term SOFR.
Mm-hmm.
Yeah, so that's the short-term agenda. And again, they are very focused, but in a world where you're not going to make significant changes to the standard,
Right.
to a certain degree, you are a bit limited
to
what you can do. So now we'll talk about the medium-term project. So the only thing that's currently on the docket for the medium-term project is to extend what's referred to in the guidance as the portfolio layer method, hedge strategies, which is you could currently only apply to assets.
Mm-hmm.
This project would be to extend it so you could apply it to liabilities.
It seems like it's pretty straightforward. Why is that on the medium term versus the short term?
So I'd say just to maybe level set for folks, what is the portfolio layer method? It's a fair value hedge of interest rate risk. Think of it as it's a closed pool of fixed rate assets that the company's hedging interest rate risk on. It's effectively where you're saying, for example, I have $100 of fixed rate loans in this closed pool, and over the next I want to hedge those over the next 3 years, and I can't tell you which loans are going to prepay or be sold or go away, but I can tell you that I'm going to have at least 80 of loans outstanding out of the 100. 80 will be outstanding at the end of year 3. And so it allows you to basically say, I'm hedging that $80 portion of the pool without identifying sort of the specific loans that are being hedged, because you don't know which ones are going to be the 80 that remain.
Mm-hmm.
So it's effectively an exception to the general hedge accounting rules. But as Chip mentioned, the issue here would be to extend that to liabilities, where people would want to apply sort of a similar concept of, I don't know which liabilities are going to go away, but I know I'm going to have at least X amount over some time frame. So this is, you think about different sort of use cases that we see out there. For banks, I think, we talk a lot about hedging sort of pools of brokered CDs. Insurance companies always want to hedge, portfolios of their liabilities. And corporates can think about, hedging pools of, prepayable or callable debt that they have outstanding on the liability side. And so I think it's a bit of a meatier change than some of the other short-term items we discussed. And so I think that's maybe why it's on the medium-term agenda.
Okay. So what are they thinking about from a long-term perspective, Chip?
Yeah, so like you would expect, the longer-term project would involve some more fundamental changes to the hedging model. And it'll likely consider a number of different paths that they could take. So one path, maybe the path of least resistance, not no resistance, but the path of least resistance would be to amend some of the, quote, fundamental rules that underlying the standard, but not all of them. So, for example, in order to get hedge accounting under today's rules, the item that you're hedging has to have the potential to impact earnings. So you could eliminate that as a requirement to get hedge accounting, which would have ripple effects to different types of things that people are trying to do. But that would be a more, I don't know about minor, but it would be a smaller change because you're just pulling one of the smaller columns, if you will, that hold 815 up.
Right.
Down.
Yeah, I mean, right. I think that, another path would be sort of a complete rewrite and start from scratch. I remember years ago when I was at the FASB, there was a board member who always used to say, like, what if you got a clean sheet of paper? Like, what would you do?
Mm-hmm.
And so that might involve, bigger ticket, more fundamental changes, like, migrating away from the current model, which really is really focused on sort of hedging, on a transaction by transaction basis, or even, sometimes, you're allowed to hedge limited, do limited pool hedging. But moving away from that sort of model to more of a, hedging net positions, more of a macro view of the world. I think banks and insurance companies often manage certain risks like interest rate risk by looking at their net exposures. A lot of our multinational corporate clients do similar things for FX exposure, where they're taking advantage of natural offsets and really just hedging sort of the open risk position. So those would be more sort of fundamental sort of rewrites, different way of viewing the world in terms of hedging versus the current model.
Right. And instead of then having all these little projects where you're just attacking things one off, maybe more fundamental changes to reshape it overall.
Yeah. And arguably that might, if you go down the path that Nick talked about, that's probably more closely aligning the accounting with how
companies are actually doing.
Exactly.
Thinking about these.
Exactly. And that's what investors really want to understand. They want to understand, like, what are the risks that companies are facing and how are they managing those risks? You know, and in the context of hedging, that'd be how you hedging, market risk and price risk and things like that. And it can be difficult to understand when the accounting model is not aligned with what companies are actually trying to accomplish. And so you could understand why that would be a difficult path, because anytime you start from scratch, it's difficult, but you could see some conceptual appeal on that path.
Yeah. And I know from my experience too, that many times companies don't even designate things in hedge accounting because it's so hard to meet all the rules and the requirements and all these tests and that kind of thing.
Absolutely. And that was a big piece of the feedback they got as well in the invitation to comment. They got feedback on specific items, like some of the things we talked about in the short and medium term, but they got more basic feedback like your observation is documentation's hard, assessing effectiveness can be challenging. And so that would be things that would all kind of fall into this longer term bucket.
Okay. Well, this has been a really good discussion. And the new hedge accounting standard, even though we just talked about some of the limitations with some of these rules, still seems like there's opportunities that it's created for both financial institutions as well as non-financial institutions. So maybe as we wrap up here, we can think about what should companies be thinking about now, or what would some of the takeaways you would give them as they're thinking about these new changes?
Yeah, maybe I'll start. We'll flip it, and we'll start. About the current standard. So as I said, that was issued. You can early adopt it, and it has some. We talked through very targeted but potentially significant changes depending on what you're doing. It does provide for transition guidance, and that transition guidance can allow companies to go in and amend hedge documentation for their existing hedges. The message that I would deliver is, think really carefully and strategically about the adoption of the standard and those transition provisions, because it's a one-time opportunity upon adoption to go in and amend your hedge documentation. So in addition to the work you would expect if a company is going to adopt a standard of building new processes, changing existing processes, procedures, and controls to adopt and comply with the new guidance, definitely take a couple of minutes, focus on the transition rules, think carefully about what you can use with the things to really set yourself up for success, in the longer term. Okay.
Nick, what about you?
I think my advice would be to companies would be just to stay engaged in the standard setting process. The FASB is constantly getting feedback on the hedge accounting model. And as you can see with sort of the ASU that was issued and these short, medium, and long-term projects we discussed, the board's engaged, they're focused on hedge accounting. And there could be, some large changes to the model coming, in the future here. But, I think if it's going to happen, I think the FASB always wants to hear from preparers and investors. So, engage with the FASB staff, respond to proposals that they put out. And as we said earlier, really to help them understand how companies manage risk, as an institution, so that, the hedge accounting model can potentially become better aligned with some of those risk management strategies.
Well, I think that's great advice. Thank you both so much for joining me today. And if people want more information as well, there was an in-depth that was released at the end of the year when the new ASUs came out, so people can find that too on Viewpoint. Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.